Good morning, Loic.
Good morning.
So looking back at 2022, it was quite a year. I wonder what were the key highlights for the last 12 months?
Well, clearly 2022 was what we can call a trend-breaking year. It came after a decade long of low interest rates, low inflation, accommodative monetary policies. And it also came after, almost 2 years of volatility triggered by COVID. So to some extent, 2022 brought us back to economics 101 and to inflation with a bang. In fact, the year started quite uneventful, but then there was the surprise invasion of Ukraine by Russia, which triggered quite some disruptions, obviously surge of commodity prices, further disruption on the supply chain, and also quite a lot of sanctions affecting companies and disrupting the economy. This worsened the already very disrupted supply chain post-COVID. This created very significant inflation because commodity prices and all this. And in the context of high inflation, then the forward interest rate curves carried on going higher and higher. Right? That had an impact on consumer spending. That also had an impact on anyone who is borrowing through a mortgage, floating rate mortgage. So basically higher mortgages, less disposable income, less consumption. So basically slowing economy and potentially recessionary pressure coming up. So all this triggered obviously a very significant market correction that we saw just after the war. And central bank started also to tighten the monetary policies ahead of inflation. So we saw 2022 on a full year basis. You've seen significant correction. Euro high yield was, I think, a bit more than 10% down. Financial debt was 11% down on the year after taking in consideration the carry and everything. So that's total return. So all this environment has actually a welcome factor for us as alternative fixed income investor is the return of yield in European credit space. And that had disappeared for a while. So I think that's really the main factor to highlight.
What was the most important aspect to how Chenavari navigated the credit markets in 2022?
Well, to be honest, when the crisis struck, especially when the invasion of Ukraine happened at the end of February and the weeks that have followed, the market actually, we could feel the experience of the team and the firm. Chenavari is in its 15th year of operation. And actually during those moments, actually being on the investment side, there was no panic. People have been through those sort of crises many times. And I think we focused on two very important things at that time, which was number one, ensure that we maintain operational controls. We manage portfolios, we manage lots of funds. And it was very important in the context of heightened volatility to be able to have, updated NAVs, real time, risk reports, drawing up new scenarios pretty much every day. And this worked quite well. The second aspect was, being on the look for opportunities. We are opportunistic investors. This is a market we know in and out. And obviously, as in any crisis, they are crisis exacerbates moves, and sometimes moves do not reflect the fundamental values, do not reflect and so we've been focused on really picking up those opportunities.
What do you think this will mean for alternative fixed income and how you're planning the outlook for 2023?
Well, certainly that makes 2023 exciting. There is basically the carry component of credit exposure now implies very significant intrinsic positive return, if I'm talking about the long leg of credit exposure. And at the same time, we know that the consequences of the macro background will start to bite in 2023. Right? 2022, to some extent, was a year where we had sort of a robust growth across European economies. And it's only now that recession is going to start to materialize. So we will need to monitor this very closely. The speed at which this is happening will matter. And one thing that is very difficult to predict for 2023 and the years to come is that will inflation return to sort of its optimal level of 2-3%, as it is basically planned by ECB, and lots of economists are forecasting a relatively fast transition to that optimized level, or will it prove to be more sticky? Will it stay around 5, 7, and potentially higher for a longer period of time? So it's fair to say that 2023 we enter with a lot of known unknowns, right? And the range of outcome is pretty important, and that could ultimately define what the year will be. Our objectives is certainly to build portfolios that will allow us to navigate well, irrespective of where we are exactly across those outcomes. But what is certain is that we know basically the key topics. I mean, there's number one, Russia, macro-wise. There's Russia, what can you predict from this? It can go from anything to peace to potentially go full nuke, even though that's not the central scenario. China is another factor of uncertainty, with this potential conflict on Taiwan. Such a conflict would be very disruptive on the global economy. Supply chain again, semiconductor, all those things are very key to global economy. The inflationary pressure, especially on commodity prices, I mean, we've seen a little bit of a relief, but if it comes back, the climate also can have a very big impact, because if we have a very cold winter, it's not no longer winter, but a very cold spring, consumptions of electricity and all sorts of energies will be obviously affecting a lot the economy, and we could see a lot of inflation. So there's a lot of variables. At the end of the day, I think we can say that 2023, from an economic growth perspective, will be between moderately bad and bad.
Let's now dig down into your game plan for the year ahead. How might corporates perform in this current macro environment?
I mean, obviously, corporate will be the most affected and impacted by this new context. Earning per shares expectations are now in negative territory for European corporate, excluding financials. The cost of debt has significantly increased because spreads have widened very significantly. And a large part of the outstanding debt is due for refinancing in the next 3 years. I think it's around 45% of the outstanding debt is facing a sort of refinancing wall of 24-25, which means that there'll be an abundant supply of new credit issuance. And there's no doubt that, obviously the market and investors like ourselves will require very satisfying yields, so probably wider yields, to absorb that new offering. Our game plan with regards to corporate means that we're going to be extremely selective when it comes to idiosyncratic credit exposure. We think that probably 2023 will be more of a year for structured finance, or any exposure, and maybe we'll come to it, any exposure such as financials or CLOs that have structural protection embedded, that accommodate for a bit of this fundamental uncertainty with regards to the macro context. Because obviously the downturn phase, the recession, is really only starting, and there'll be lots of downgrades for corporates, there'll be increasing amount of defaults, rising dispersion, and definitely a wide range around central scenarios. And that will create obviously opportunities for shorting, and in a long-short investment mandates, obviously well-picked shorts could prove extremely profitable in the current environment.
And beyond corporates, where else do you see opportunities in tradable credit over the next 12 months?
Well, as I said, I think the game plan for 2023 is very centered around I would say, structural finance and, let's say, financials, financial debt in particular. We think that both sectors will exhibit very strong performance in 2023. Our position as a firm, Chenavari, has very deep into European financials, both from the investments and basically buying financial debt and so on, but also with the interaction that we have with banks, like acquiring portfolios, entering into regulatory capital transactions with banks. And we think that that interaction and that deep knowledge of bank will be a powerful differentiator for us in 2023. Banks will benefit from the increase in rates, in interest rates. And as long as recession remains shallow enough, that means the net banking income of banks will actually increase significantly. We have currently facing with very cheap valuation, fairly high yields for bank debt. And most of the banks, again, for any investor that are able to go very precise about regulatory capital and all the aspects that affects bank financial ratio, they have a sound financial structure and in that context look quite cheap. So banks and, as I was mentioning, structured finance and in particular CLOs, European CLOs. So we're talking earlier about corporates and the fact that there's a rising default environment for corporates. And that's why we prefer, in this context of uncertainty with regards to the rising default rate, we prefer to use all the expertise and the knowledge and the analytics of Chenavari to actually stress test, CLO offerings, CLO both primary and secondary tranches, to actually focus on those exposures which are able to sustain very significant adverse environment in terms of default and lower recoveries and so on. And we see there's a lot of very high yielding CLO tranches at the moment. And if you're able to choose well and basically stress those bonds quite well, we think that a lot of them are offering very strong risk-adjusted return because they are in fact able to sustain 6, 7, 8% running default rate for a long period, while we're currently standing at 40, 50 basis points. We think that our funds and investment vehicle will seek to embrace obviously beta, right? Because we think that eventually, spreads, there'll be an element of normalizations of spreads, but also seek to collect very strong risk-adjusted carry during the upward movements of the market. And at the same time, we'll try to obviously protect with smart shorts, a lot in corporate, to basically, accommodate better the periods of volatility.
Let's move on to the second element of your game plan for 2023. How does Chenavari assess the market opportunity within private credit and specialty finance over the next 12 months?
Well, I mean, as you know, it's a key component of the firm with tradable credit. And so as far as private credit and specialty finance, obviously we will pursue opportunities that we think are really justifying the illiquidity premium that basically you find in that you have to find to extend the liquidity, right? Your tradable credit spreads are wider, so obviously you only focus from the private credit and specialty finance standpoint on asset classes that are providing you with an attractive return and a steady return that is able to support deterioration of the fundamentals in the economy, right? So we think that there are really two types of opportunities that we really value and on which the firm is focused for 2023 in terms of private credit and specialty finance. The first thing, it's what we call specialty finance credit origination, which is centered around granular loan portfolios, such as consumer loans or mortgage loans, right? We are basically giving our LPs, our investors, the ability to access either through dedicated account or through commingled funds to access those granular loan portfolios, which are originated either through banks directly, where we then acquire those part or share part of that origination with banks, or through specialist companies called specialty finance originators across Europe. Those portfolios, because they're granular, have a much more predictable return, because it's very diversified, so you can stress and use all analytics to basically look at what the performance of those granular portfolio will be into a more adverse environment. We are mainly working with seasoned originators, so whether they are banks or specialty finance partners. We, as Chenavari, as a team, we originate close to 1.5 billion euro per year of those granular loans across geographies in Europe and across asset classes in Europe. And as example, I can say that we have partnership with mortgage originators in Ireland, with consumer lenders in Spain, Italy, Belgium, in the Netherlands. And so basically those diversified asset class and geographies are creating a very interesting mix in terms of resilient granular loan portfolios that can either be put into our funds and portfolios either on an unlevered basis, or basically we can structured some sort of senior financing with in the form of warehouse with banks, and then wait for real upside when the securitization market reopen and where we can securitize those portfolios in the market. The second part, we're in an environment where valuation, real asset valuation, starting with real estate valuations, have gone down significantly. So obviously when the valuation goes down, it's actually, and obviously when there's a bit of adversity in the market, there's less supply of financing for real asset. So there's an opportunity to do some real asset-backed loan, so or other called LTV loans, right? Loan to value type of transaction. When the V is low, it's actually always a great time to do LTV-based type of financing, because you may end up on a normalization on an even lower LTV down the road. So obviously you pick very well the type of real assets that act as collateral of your loans, but in terms of real estate, which have suffered very significant down mark in terms of valuation, or transportation assets like for example shipping has also had a very significant contractions in terms of asset values. So there's a large array of real assets that is now providing very attractive collateral for financing, and the bank appetite for such loans in the current environment is less. So therefore, as an alternative lender, we have a very wide array of opportunities on which we pick and select for our portfolios.
What would you say, Loic, would be your key takeaway for 2023?
So 2023, in our opinion, is the beginning of a new 2 to 3 year cycle, similar to potentially a cycle that we saw, starting 2011, 2012, which was a 2011, 2015 cycle. I expect that cycle, that investment cycle, will be extremely supportive of alternative fixed income if we compare it to, other asset classes, because we start the year with elevated credit spread, while the default risk is extremely moderate. So basically the implied default probability that we see in those spreads is very significantly higher compared to even the stress that is expected on the fundamental side. So I think the motto for 2023 is to look for strong risk-adjusted carry in the alternative fixed income market, whether basically it is credit, structured finance, or private credit, knowing that two of the areas of the tradable credits that we favor are structured finance and financial debt, and knowing that on the private credit side, we will be looking more for granular portfolios because they are more resilient, more predictable, and for real asset-backed loans.
Let's shift focus now to company updates. Chenavari is now in its 15th year of operations. Could you just give us an update on where Chenavari stands today?
Yeah, I mean, the Chenavari is obviously now a grown-up company, with pretty much the same people over the time. We stand in 2022, I think we've been between 5 and 5.5 billion of assets. We have 80 professionals that forms the firm through 3 regulated offices in London, Luxembourg, and Paris. We just rolled out in Paris our hub to cover the European institutional investors and also to manage some strategies tailored for European institutions. If some people ask me what's your DNA, and our DNA is we want to be the go-to asset manager for allocators seeking to invest to alternative fixed income in Europe. Whether it's through commingled assets or something we do quite well is basically, like long-term partnership in the form of dedicated accounts, SMAs or fund of ones, where we can customize strategies across all our expertise. We cover the full scope of liquidity across credit, structured finance, and private credit. So from daily liquidity funds to permanent capital vehicles that will do some longer dated type of strategies.
What would you say makes Chenavari such a special place to work?
Well, we're an asset manager, right? We only have one raw material. This is our people, our team. So Chenavari is formed by what I consider talented, most of them very long-standing professionals, and they are all either experts, investment experts in the markets, or experts in all the operations around asset management. And we value the same way great investors, great analysts that brings investment ideas, and like all the operational control that we have that ensure the consistency of our reporting, of our our risk management and technology. Right, this is very important. We're a technology company. Our values definitely promote sort of collaborative behaviors, and we're also trying to encourage initiatives to always find the best investment ideas, but also initiatives to always make the firm a better firm, a more efficient firm. Among those initiatives, there's one that we definitely should talk about because it's been years that Chenavari recognized that climate change is real and demand urgent action. So for example, we were one of the, if not the first managers in Europe on the CLO side, to apply some ESG selection criteria, ESG filtering on the underlyings of the CLOs. That was years ago. We were not even talking about the terminology ESG and all this. Despite all the political statements, all the flurry of green commitments from companies and governments around the world, there remains still a significant gap from where things stand today and where we would like them to be, right? And in particular, where goals are set for 2050 and all this. I mean, a lot of things need to change.
And how exactly does that translate in terms of your commitment to energy transition?
We've conducted quite a lot of loan transactions where we have included some green and sustainability-linked features, such as, for example, for the borrower, we give them some targets, to achieve in terms of energy transition, and if they meet those targets, we'll reduce slightly the interest rates that is being charged by our funds. So our funds at the same time are able to deliver a steady return, attractive return for investors, but also really are participating to promoting, encouraging, this energy transition. So that's one example. Another example would be what we do. We do a lot of transportation asset-backed loan. So there's a lot of things that where our loan covenant are aligned on the what is called the IMO 2050 decarbonization strategy, right? So which basically force borrowers to adhere and really implement those goals in terms of transition. Finally, one last example is we are promoting an impact real estate fund that is basically making sure that any borrower under that debt fund will basically have commitment towards energy efficiency, right? To ensure that whatever buildings we're financing, is strictly complying with what is expected in terms of energy efficiency, but also all the strategies related to urban renewal, decarbonization. And so those are the type of steps that we take, whether it's by promoting specific products or by applying covenants in our loan documentations or our investment strategies, even on the liquid market. I mentioned the CLO aspect. So those are specific steps that we've been taking. I think I should mention as well what we do more from a broader ESG initiatives at the firm level. Chenavari has promoted, and again, from all this came from the team. That's very important. It's not just like, well, we think it's important for marketing, whatever. It came from the team. So those initiatives is a payroll giving scheme where basically the teams are selecting specific cause for which we'd like to make donation. And so the employees are giving, and Chenavari is matching up to a certain cap each year to those donations. Finally, as far as, I told you, we are a people business. So it's very important the people we recruit. So of course, we select our people according to very strict criteria, and our recruitment process is quite well known in the market. But we also implemented in the past few years what we call a diversity and inclusion work stream affecting all our recruitment to ensure again that, when we talk about ESG, it's a reality within the firm that is really lived and embraced by everyone.
And what are your objectives now for the next 5 years?
Well, as I said, we've been 15 years in business now. So it means that for 15 years we've been facing both private investors, family offices, but mainly institutional investors around the world. And basically our track record in delivering steady returns to those investors is bit by bit, and every day that passes enhance trust and basically confidence that we have with those long-standing partnerships. We definitely have the muscle, the capabilities, the people, the intelligence, the system to actually be a larger firm, and it's very important for the reach we have in this market to be a larger firm. So our game plan for the firm in the next 3 to 5 years is basically to become a 10 billion AUM company. So, not double, but basically significantly grow. But generally speaking, investors are surprised that we are to see us only in the 5 to 6 billion bracket in terms of AUM, and so because we are so institutional today that we could definitely manage much more money. We want to be focused on our market, which is European alternative fixed income, however.
Thank you so much for your time today, Loic. It's been a real pleasure.
Thank you for the conversation. Thanks.